Today's topic for discussion is Elliott wave theory. Let us start with the introduction. Elliott wave theory was introduced in late 1920s by Ralph Nelson Elliott. He was an accountant and an author. This theory is also called as wave principle. It tells you how to identify, predict and capitalize on the wave patterns that are made by tracking stock price of the company or of the market. In short, it is traders' ability to convert price action into a trend. He identified wave patterns and made detailed market predictions based on these patterns. This is an Elliott wave cycle. On the x-axis you see price and on the y-axis you see time. In this theory, stock prices are used to track the movement of the market. So the stock prices form waves for a particular time duration. It states that stock market follow a repetitive rhythm of a 5 advanced wave followed by 3 decline wave which forms one complete cycle. So over here 5 advanced wave means 1 to 5 wave that you see, and the decline waves are wave A, B and C. 1 to 5 wave, they move in the same direction, so they are called impulsive or motive wave, whereas A, B and C, they are moving in the opposite direction, they are called as corrective waves. There are 3 thumb rules that are to be followed in Elliott wave theory. The first thumb rule is wave 2 that corrects wave 1 will never retrace the starting point of wave 1, which means wave 2 will never cross the starting point of wave 1. Similarly, the second thumb rule is if you see a blue arrow on wave 3, that wave 3 is considered to be the largest and strongest wave among advancing wave. They are wave 1 and wave 5. So this wave 3 can never be shorter to wave 1 and wave 5. The third thumb rule is that wave 4 that corrects wave 3 can never enter into the price territory of wave 1. If you see, there is a green diamond and a red diamond on wave 1, so that is the price territory of wave 1, and the rule is that the fourth wave, when it corrects third wave, it will never enter in this price territory of wave 1. So this is what Elliott wave cycle thumb rule is. Let us go to the next slide for detailed explanation. These are the 3 grave rules which I had spoken about wave 2, which can never cross the starting point of wave 1. Then wave 3 is not the shortest among the impulsive wave, that is 1 and 5. And wave 4 can never cross the price territory of wave 1. This is how a bullish Elliott wave cycle looks like. So I've just taken a chart, a random chart, to understand how does it look when you track the stock price. So over here, a bullish Elliott wave cycle is starting from the month of March and it is there till July mid. So this is how it is tracked. And you see again a new cycle is starting from mid of July, that is a new impulsive wave 1 is starting from there. So basically it is repetitive in nature, and the investor seeing this wave will decide from which wave he has to start to buy and from which wave will he exit or book a profit for himself. There is a detailed explanation of every wave given by me in the next slide, so let us see that. There are 3 important aspects of wave theory. The first is wave pattern. It tracks the stock price movement in a pattern and helps investor to decide when to invest and when to exit. Then second is the ratio. It helps comparing the length of each waves. Basically it is used to measure the relationship between different waves. And last is your time. It is used to confirm pattern and ratio. The detailed explanation is given in the next slides. This is wave personality for bull trend. So let us talk about wave 1. Initially, in wave 1, the economy does not look much strong. The sentiments are bearish. The investors have just started to invest in, and the volume may pick up a bit. This is wave 2, which is a correction wave, and it corrects wave 1. So here basically the sentiment is bearish because the market is moving in the opposite direction. So when wave 2 corrects wave 1, it may fall 50% from the wave 1 or 62% of wave 1. Volume traded in wave 2 is low compared to wave 1. Because the sentiments are bearish, so people are not sure whether the market will move up or not. Wave 3 is considered to be the largest and powerful wave among the 5 impulsive waves. So if you see, wave 3 is 1.62 or 2.62 or 4.25 times lengthy compared to wave 1. Initially what happens is the market slowly and steadily start picking up. At the midpoint of wave 3, the public start investing more, buying more and more of shares, and as they know the news is positive, the market will touch a new high, so price will be rising quickly, and the volume will be the highest traded in wave 3 compared to all other waves. In wave 4 corrects wave 3 and moves in opposite direction. So when the price start moving down, there are more buyers who enter into the market thinking that the price may rise again. So there is more buying sets in, and wave 4 falls 24% or 38% or 50% of wave 3. Wave 5 is the final leg in the direction of the dominant trend, and it's 1.62 or 2.62 times lengthy compared to wave 1. Here basically the news is positive and bullish, and many average investors step into buy thinking that price will touch a new high. But in wave 5 the volume traded is lower compared to wave 3. We can say that profit that an investor makes in wave 3 is much more compared to wave 5. This is wave A, so this is where the corrective wave starts. Wave A corrects wave 5 and moves in the opposite direction. It starts moving down, the stock price starts to fall, and it becomes difficult for investors to identify these corrective waves as they are a bit confused. They think that the market may again pick up and touch a new high, but it doesn't happen over here. Wave B is the second corrective wave. So once the market starts falling down in wave A, it slowly start picking up, or you can say start moving up. The volume will be lower over here compared to wave A, and more buyers enter in thinking that the market will pick up again. In wave C, you see market moving down. Many market participants become nervous, they start panicking and they start selling their shares. There are very few buyers seen over here. Similarly, this is the last wave in the Elliott wave cycle, and it is as long as wave A. After this, at the end point of the wave C, you will see a new impulsive wave, that is wave 1, starting again. Basically, this Elliott wave cycle is repetitive in nature, so again the wave cycle will repeat. This is wave degree. Wave degree means you track waves within waves. So suppose your first wave is an impulsive wave, so you can track 5 impulsive wave within the first wave, and the remaining ABC corrective wave can be tracked in the second wave, which is correction wave to 1. Again on the third wave you can track 5 impulsive wave, and on the fourth wave there will be the 3 corrective waves which are ABC. So this is a continuous process which can be tracked. This was all about wave degree and Elliott wave cycle. Thank you.